Back with markets noon and lots to talk about, but let's shift the spotlight and talk about the banking space and the NBFC space and exactly what we're expecting to happen over there. Because remember, last week, a couple of days in a row, you had Nifty Bank that was scaling fresh highs, so that has worked out very well for the banking space. You've also had good participation from PSUs, ECL provisioning, and of course, all eyes are going to be on what happens in the policy meeting next week and what, of course, the impact is going to be on the entire financial space. So let's talk about this and much more with Mr. Parag Thakkar, Senior Fund Manager at Fort Capital, who tracks the banking and financial space very closely. Mr. Thakkar, hi, good afternoon, and thank you so much for your time. Let's start by talking about the rate cut scenario, if that does happen next week. And based on the governor's comments yesterday, we believe that there is room for another rate cut, is what he said, and maybe that is something that we could see next week. Given this, what do you think the impact on the lending rates of banks and NBFCs could be?
Yeah, so basically, we have definitely, as our RBI governor said, that we have a room to cut rates, definitely, because inflation is undershooting. Oil is at 62. So definitely we have a room to cut rates further. For banks, this means that for the larger banks like SBI, HDFC, ICICI, Kotak, where above 50% of the loan book is at a floating rate. When the repo rate is cut, definitely they'll have to reduce rates. Lending rates. But I would like to believe that RBI will also support this with liquidity action so that their margins don't fall too much, because deposit repricing takes its own time depending upon bank to bank. But I would say this will stimulate growth further. Apart from the facts that whatever government in RBI has done up till now by cutting GST, income tax slab increase, so I would say that all these actions will lead to further growth also. So in my view, credit growth should increase gradually. Even if the rates are cut, if it is followed by liquidity action, then margins will also compress very slightly. I would not say meaningfully. And remember, in this quarter itself, we were expecting a lot of margin compression because of 100 bips repo rate cut. But banks like SBI and Federal, which happen to be our top holdings, they manage it so well by increasing their current account and fee income. So I would say that banks are managing it very nicely. And if RBI supports rate cut with liquidity action, definitely the margins will have protection, plus credit growth will also increase. And for NBFCs, just to come to your point, definitely the NBFCs who like vehicle financiers, who lend at a fixed rate, they will clearly benefit because their cost of funds will come down. So their margins will expand.
Right. Mr. Thakkar, also as far as large private banks versus PSU banks are concerned, where do you see, where is the risk-reward ratio placed better? Because if you look at the private sector banks, the margins are still, there's still pressure on the margins. And PSU banks have done well because they're playing a catch-up right now. So private versus public sector banks, where do you see risk-reward to be better right now?
I would say that, PSU banks had a very good run. And of course, SBI still offers huge value. If you see, the valuations of SBI are not yet stretched at all. And they're doing extremely well. First of all, one common thread amongst large PSU or large private sector banks is that asset quality is absolutely not a problem, which is a fantastic thing to have. There is no asset quality issue in SBI, HDFC, ICICI. Even Axis, it is going to improve only, or even say Bank of Baroda. So one common thread between all these banks is that credit cost is absolutely under control. Imagine SBI 44 lakh crore loan book and credit cost of just 0.39%. So all are well placed. I would like to say that SBI has big advantage because the domestic CD ratio is also only 70%. So if there is a rate cut and if there is a fight for deposits, SBI is very well placed. So if they have operating leverage, they can give loans even without raising deposits too much, which is a big advantage for them. So I would like to believe that the banks with CD ratio, which is lesser than 85%, like SBIs of the world, are in a much better advantageous situation as of now.
Okay, and Mr. Thakkar, while we're talking about large private sector banks, what do you think the impact of ECL provisioning and the capital charges is going to be on these large PSUs?
So basically, everybody has said it, right, that it is going to be a minimal impact and it will be spread out over 5 years, as SBI chairman has said. So the impact will be very less. And HDFC, for example, HDFC has done so much of prudent provisioning earlier only that they will not be hit at all in my view.
Right, Mr. Thakkar, also, are we entering a more competitive deposit environment, or the falling interest rates ease the pressure or the funding costs?
Yeah, definitely. See, if deposit rates are further cut, I would say repo rates are cut, then they'll have to cut term deposit rates, and that will actually, discourage savers from going into FDs, which already is the case because they are putting money in equities and gold and silver. So I think going ahead, if the rates are cut, and if it is not accompanied by a liquidity push in the form of CRR cut or OMOs, by RBI, then we fight for deposits, because saving rates from large banks are already at 2.75%, so they cannot reduce further, in my view.
Okay. And Mr. Thakkar, given that Nifty Bank is just about at its all-time high now, how much of a further run-up do you think there is in terms of a risk-reward for investors, or do you believe that NBFCs could be where we could see the next growth rally coming from?
No, so NBFCs, we are also constructive. We have Tata Capital in our portfolio. So, for example, so I would like to believe that this rate cut cycle is more beneficial for NBFCs without any question, because it lowers their borrowing cost, and so they will do well. But I would like to believe that the economy is doing so well, and the segments where these large banks lend to are so safe, that credit cost is so low. And if the economy GDP growth revives due to consumption-led stimulation, which has been given by government, I feel that all lenders should do well, large banks typically, and good NBFCs who have calibrated and prudent lending.
Mr.
The
Thakkar,
key to this sector's outperformance will be in credit cost, and credit cost, so long as it remains under control. For example, we have Axis Bank, right? They had one or the other issues in last 2 or 3 quarters, but it appears that now that issue is behind. So those kind of banks also can outperform.
right, Mr. Thakkar, so how long do you expect it will take for the Indian banking landscape to consolidate to a top 10 structure, and what catalyst would accelerate or delay that consolidation?
No, it is going to happen. See, on one side we are seeing banks like RBL, where Emirates kind of a foreign investor is taking stake. On other hand, government wants to push for consolidation within PSU banks. So it is all happening, and I think right now as we speak, as I said, asset quality is no longer an issue, and that is why all this consolidation makes sense also. So, for example, we'll have IDBI stake sale, which will be bought by whoever who is the bidder, Kotak or Fairfax or Emirates. The one thing which earlier was used to be a dampener was asset quality. Now, even if somebody buys a PSU bank, there is no problem with asset quality.
And what about the private sector banks? Any asset quality concerns if you're seeing over there?
Sorry, in private sector banks.
Yes.
No. So basically, those who are blended to secured segments. For example, if you see one of our holding, which was City Union Bank, they had actually negative slippages. So those who are lending to secured segments, those guys don't have any problem. Those who are lending, select NBFCs which are lending to MSME unsecured at higher yields or microfinance, there you will have some problem, but there also, I think the problem is peaking out.
All right, Mr. Thakkar, thank you so much for taking the time out and joining us
Thanks.
today. Good day to you. And with that, it's a wrap on this edition of Markets at Noon. Snehi and I will take your leave. Thank you so much for tuning in.